Hey gang, welcome to another one of these investor presentation reviews, the only show on YouTube where you can hear a guy talk and blather on about investor presentations for about an hour. Today we're talking the music industry. Reservoir Holdings is going public via Roth Capital's second vehicle, ROCC. Not a great enthusiastic response from this acquisition from the market, basically trading below NAV at $9.95 as of today, Friday the 16th. This is the second Roth Capital vehicle. The first one was Pure Cycle, which was a big success for investors. It's trading about 27 bucks right now, 3 billion market cap. So you've already doubled your money if you invested early on. Below or close to the $10 range when it first started trading. ROCC was one of those, hey, this is a good management company. They did well on the first try. Let's run this up to 1148 before we know what's happening. Then the big market crash for SPACs happened that, hasn't really gone in line with the rest of the market, which has still gone up quite a bit, but it really affected people who were really buying into the SPAC boom then, and since then things have kind of petered out. A few SPACs have done okay here and there, but most of them have kind of stuck around NAV, and this is no different. At the end of the day, I think today is a better buying environment than it was 2 months ago, no matter what people tell you, right? You were spending $11.48 on this one for $10 of cash because you had no idea what was going on. There were certain SPACs I owned, QELL, that traded up to $14 before a target was announced just on the basis of management. I was a seller at that point because it was absolutely insane. But now that SPACs are back to around $10 around net asset value, they're an interesting proposition, and I'm looking at these and potentially investing some more money in it. Note that I do own ROCC. I bought it a couple weeks ago before the target was actually announced for the same reasons that I buy some other SPACs. It was under $10. It was a good place to hold money at that point, and the team here is pretty solid based on their first announcement. And I am interested in this deal. I don't think it's got a great reception so far, but my thoughts on the music business are that it is an interesting business to be in. And if you kind of look at what has happened, what has transpired in the global music industries, it's been a couple of years of recovery after a big downturn due to the emergence of digital recordings. But I think what has really helped this industry recover is the emergence of platforms like Spotify and platforms like Apple Music, where people can listen to anything they want multiple times without paying an additional fee, and they're more than willing to pay $9.99 to access a library of everything versus paying 99 cents for a song or $14.99 for a CD. So physical media has gone downhill, but it's been replaced in a big way by streaming, and streaming has still got a long ways to go. And I think that's the thesis behind this investment. If you look at Spotify, in 2011, those guys had 3 million subscribers. They're up to 150 million and growing. If you look at Apple Music, they started with 10 million in 2015. They're up to 60, 70 million now. They don't really release those numbers. But this is a market that is still under-penetrated, if anything. 150 million seems like a lot. 80 million on Apple Music seems like a lot. But the penetration of emerging markets is somewhere in the mid-single digits. The penetration of domestic markets, it's maybe in the 15 to 20% tops. So there's a lot of people who do not listen to music digitally, and there's a lot of people who will in the future. And I think that's the growth thesis here. I think that's why Roth is interested in this investment. And I think it's an interesting investment to look at. There is a third angle that I'll talk about later. I think people think about NFTs when it comes to music, and I think there's potential there, but I also don't want to bet on that as an absolute yes before I make an investment in something like this. It's an added bonus if the investment is interesting and priced well, but it doesn't necessarily mean that I should invest on something simply on the basis of NFTs. I kind of talked about that in my MUDs video, where it is a mature business that generates revenue, and is it priced appropriately? And if the answer is yes, then I want to invest in it. And if there's an upside due to NFTs, then I want to invest in it even more, right? And is that the case here? I guess we'll see. You've seen boring companies like PLBY kind of run up quite a bit. You've seen even MUDs already kind of a boring company that's got an NFT angle. It's up 30% since I talked about it. There is upside in these boring companies if they are boring companies, if they're generating revenue already, if they're generating cash flow already, because these are real businesses, right? There's a lot of hype to SPACs because, hey, there's a rocket ship company coming out. There's a robot company coming out. There's all of these 77 EV companies that somehow all have $5 billion valuations, although probably one or two of them will make it through this whole thing. But this is not something like that. This is a black and white presentation of album covers. Is it interesting? I think so. Is it interesting to the overall market right now? I don't know. I don't think it is. And maybe it's getting passed by, and maybe it's an interesting investment. So let us take a look at what's going on here. Hey, they own a Madonna album. There's an Usher album here. Evanescence Fallen. What a great group of albums they've got here. So what are they doing here? Transaction overview, Reservoir Holdings and Rocc 2 are combining. Transaction is expected to close by Q3 2021. They're going to trade under ticker RSVR. This is kind of why I like SPACs right now. You have a place to put your cash if you have cash. You can buy this at $9.95. If you don't like the deal before Q3, if you don't like what's happening before Q3, you can kind of sell. It's going to be around the same price. You can trade in your money for $10 or whatever the net asset value that's remaining is left. Most people don't take that option, but you can have that option. And if there's upside, there's upside. So assuming that the company sucks, maybe this is one that I'll actually put some money into, depending on the valuation. So speaking of valuations, here we go. $740 million post-money equity value with an adjusted enterprise value of $788, which implies a 20x EV over EBITDA multiple based on 2022 estimates. So 2022 estimates, it'll be interesting to see what it means based on 2021 actuals or 2020 actuals. 20x is decent. If you look at the multiples that you see from some of the other players in this space, there's Universal Music Group, which recently sold a 10% share to Tencent Music. That valued at about 30x EBITDA. Warner Music Group, which went public recently, is also valued at about 30x of EBITDA, valued at about $19 billion. I kind of took that EBITDA valuation based on their 2019 EBITDA, trailing 12-month EBITDA, because it seemed like in 2020 they kind of were hit quite a bit by the pandemic. So it's interesting to see what comes of that. And then Hypnosis is another interesting company that recently sprung up that kind of started buying up music catalogs, and they're also valued around 30x based on their 2020 EBITDA. So that's kind of the valuation you're working with, and it's good to have some comparables. So at least based on 2022 E valuations, I'm assuming it's closer to 30 based on 21 valuations. Valuation seems fine. Existing shareholders are rolling 100% of their equity as part of the transaction. There's $150 million in PIPE, and there's $246 million in cash going to the balance sheet net of expenses. Pretty good. I like deals structured like this where people are staying in, management staying in, and cash is going to the balance sheet. They can use that cash to grow that EBITDA in the future as well. So that'll be interesting to see what they plan to do with that. What Rocc Capital likes about Reservoir, it's an uncorrelated asset class. And what that means is that it potentially does well when other things don't do well, right? If you look at streaming, streaming didn't go away during the pandemic. People stream music. People watch videos that probably have music in it on YouTube, where potentially companies like Reservoir make money. If something else happens, if there's an economic recession, people are probably still going to listen to music. And now that music has moved into the internet platform, it's easier for people to access music than it ever was before. And that's a good thing for companies like Reservoir. And also, I think stuff like this, owning recordings and owning albums and owning catalogs, to me seems like a luxury asset in a way. And a luxury asset is something that's valued more than the sum of its parts, right? More than its ability to generate income. Kind of like if you look at MSGS, something like that, Madison Square Garden sports company, own the Knicks, own the Rangers. They're valued at $5 to $6 billion, depending on the day, for whatever it is. those companies do not generate a ton of money, right? They're not even profitable half the time. They don't generate a ton of money, but they're worth 5 to 6 billion because millionaires are willing to pay 5 to 6 billion for them, right? And that's been proven time and again as people buy and sell sports teams. And this isn't that by any means, but I think there's something to be said about, do rich people value something like this? How they would value an expensive bottle of whiskey, an expensive piece of art, something like that. And I think the answer is, yeah, maybe. I think there could be something to be said that, hey, these things are going to always have a bigger multiple than the market because these assets are cool. And that's it, right? These assets are cool. They're albums, they're music, they're art. And they not only are they that, but they also generate money. So it's a double whammy. And maybe that's the reason that, hey, these things are trading at 30x when the rest of the market is trading closer to, depending on the industry, 13 to 20x or something like that. So there's attractive industry dynamics, powerful secular tailwinds. What are those tailwinds? Spotify, Apple Music, more money being generated for these companies via each listen, repetitive money, potentially longer lasting money because of what's going on. Another thing here, are NFTs in play for a company like this? Can they do something with that? If you look at Hypnosis Songs, let me see if I can find their website here. They already have a little spot here that says, hey, NFT licensing. Want to use some of our money, some of our music in your NFTs? Send us an email. Is Rocc, is Reservoir Holdings thinking about something like that? If you look at what has gone on with NFTs, in January 2021, music sales or primary NFT sales were 860K. February 2021, 21.9 million. There's already been multiple releases of music-related NFTs, whether it's art combined with a song, whether it's just albums being re-released. I think of this as not a huge growth driver, as some people do, but I think of it as a cool way to introduce things to collectors who love a certain artist, right? Let's say Sheryl Crow or whatever this album is has a 20-year anniversary coming out. Let's re-release it on the blockchain as this unique thing with new cover art that is unique to the blockchain and sell it for $20 with a limited edition run of 10,000 copies. Sheryl Crow makes money, Reservoir Holdings makes money, everybody makes money. Great album, by the way, Rag and Bone Man Human. Check it out. Awesome album. Glad that they own it. They're an M&A machine, active ownership approach, driving down transaction multiples, infrastructure in place, create substantial operating leverage. I mean, this is this type of company. It's a holding company at the end of the day. They're going to buy catalogs, buy more music, and now they've got 250 million in cash infusion to do that, and hopefully buy something that helps them improve their EBITDA and cash flow and stuff like that. And I love companies like this, honestly. Before I even look at all of the financials, I like companies that are already generating their own cash flow because they're not dependent on this money to exist. They can use this money to acquire more things and improve that cash flow generation. And in the future, that natural cash flow generation is going to help them acquire more. And if you've got good leadership at the helm, then you're going to do well as an investor. So you've got founder-led owners rolling 100% of their equity. Who are they? You've got a management team, Rel Lafarge, Jim Heindelmeyer, and Golnar Khosravani. So again, I talked about assets being more than just the sum of their parts being worth more than the sum of their parts being luxury assets. She is part of a rich family, certainly a very smart woman, certainly one that has led this company to great growth and a path towards going public. It's very tough to compete in this business against some of the bigger players, and they've done very well in building a decent catalog from what I've seen. But again, she is a billionaire. Her father is a billionaire. Her brother, maybe she's not a billionaire, but her father is a billionaire. She comes from a family of well-off, smart people. Her brother or cousin is the CEO of Uber. So is this an asset she's managing because she needs to make money? No. It's an asset she's probably managing because she loves music, she loves the industry, and she wants to own a piece of it. It's a luxury diamond asset for her. And I think that's why some of these valuations are going to be higher for companies like this. And I think that's why some of these people are going to stick around with the company. All of three of these guys have been with the company since it started. They've been in the industry for a while. And I think they're a good it's a good sign for investors that these people are still involved, that they're not selling out, they're going to be continually involved, and they probably treat this as a jewel more so than an asset that they need to depend on for money, and that's a good sign for investors. So Reservoir, they've been founded in 2007, best in class. They've already deployed 400 million capital through M&A with a significant deal pipeline. They've got 100 million plus of futures spend with enhanced risk return. And if you don't know what futures spend is, it's basically contracts with artists to write music for them for a couple of years. They're based in New York City with offices in various other cities. 2021 revenue about 80 million. So again, it's not a huge revenue company, but I think a lot of this revenue is pretty high margin, and hopefully it has a pretty decent growth rate here. Most of that is music publishing. Some of it is from recorded music and other. So they've got a regular top 10 US market share, Music Week Awards Independent Publisher of the Year, blah, blah, blah. Their founder CEO was in the Most Powerful Woman in Music list for 2017 through 2020, in the Billboard's Power list from 2020, and they've got 16 Songwriter Hall of Fame inductions. So at the end of the day, this company's value and some of its value and is going to come down to two things. One, how much revenue and how much EBITDA are they producing, but also what artists do they have and what is the long-lasting impact of those artists, right? How reoccurring is this revenue? So investment highlights, we can kind of look at valuations here. We're talking about a 788 enterprise value. So 788 divided by 29, which is their EBITDA for 21. 27x. You're paying 27x against 30x for some of the other players. At $10, this seems like a reasonable value. You can kind of see that their projections for 2020, 21, 22, their growth is pretty good, 26%, 30%. If you look at some of the other players, Warner Music, Universal, obviously they're much bigger. They're a huge piece of the pie, probably catalogs of 1 million plus songs versus whatever these guys have, but their growth rates are going to be a lot smaller. But then their market cap is a lot higher as well, right? You're talking about 20 billion market cap plus versus less than $1 billion at this point for this company. So a lot more growth paths for this company, but obviously a lot less power when it comes to negotiating with some of these music industries. But I think that's changing as well. I think the days of Universal and Warner having all the power, it's different now. It's different with streaming. I think there's a space for these independent producers to still do well and grow. And we'll have to see if that's true, and we'll have to see if they actually do have an evergreen catalog and contemporary hits, because you do want a catalog that kind of keeps the revenue coming in, but also you want to grow through hits that are new and have long-lasting potential. So what's their growth story? Started in 2007, picked up TVT Music Publishing, Philly Groove Records, Reverb Music, etc. They got Sheryl Crow over here. They got 2 Chainz. They got Hans Zimmer. Hans Zimmer's the man. The Commodores, Joey Bad. I don't know most of these people. Ben Harper's pretty good. Young Thug. Isley Brothers. They picked up Chrysalis Records recently, and Pop Arabia, which we'll talk about later, and Shapiro Bernstein, which I think owns some decent hits there recently. So Pop Arabia is interesting, but that's kind of speaking to the expansion into emerging markets. There's going to be a growth story that has to be spun around this, and that growth story is basically going to be, hey, the emerging markets are very underpenetrated due to lack of expansion from Spotify and Apple Music, but that's changing, and it's changing quickly. And as those emerging markets get more involved in the streaming music space, the revenue for companies like this is going to go up quite a bit as well. So that'll be interesting to see. Industry, the 2010 to 2020 to 2030 projections are here. The industry is massive and growing, right? Publishing is growing at about a pretty sizable rate here. Your recorded music slightly lower, but will continue to grow into the 2030s. Then you got your paid streaming subs, which is exploding between 2010 and 2020, but still growing quite a bit in between 2020 and 2030. So you've got your digital rights becoming a much bigger piece of the pie every decade. You've got your performance rights still being there, quite important there. You've got your sync rights, which are basically like movies and YouTube licensing, stuff like that. Nothing about NFTs here. Is there potential there? Potential upside here, maybe. And then you've got your physical and other becoming a much, much smaller piece of the pie. So really the story here is digital streaming. How can they make more money from streaming? And if they can, then this is going to be a pretty good growth story because streaming is clearly set to expand. Are these optimistic? Maybe. Are these pessimistic? Maybe. You can't really tell, but you can sort of say that, hey, the clear trend is that more and more people are moving digital, and that's not going to change because I never buy music anymore. I have an Apple Music subscription. I use it every damn day. My wife has one too. We don't own a CD in this house. We just don't own a CD. Do people own CDs these days? Like I have some that I left in my parents' house, but I don't actually own a CD. I don't actually buy music. Whatever I listen to via streaming. And every time I stream a song, that is owned by Reservoir Records, they get, 1/1,000,000th of a cent that they get to split with the artist and themselves and other parties. And that's how they make money, right? So digital annual growth, big. Growth of paid subs, big. Growth of streaming in emerging markets. You're talking about 30% of subs by 2030 coming from emerging markets versus mid-single digits today. I think that's why their expansion into the Middle East with the acquisition of Pop Arabia is important. I think that's cool to see. Expansion of emerging music monetization platforms. Can they monetize TikTok, Netflix, Peloton, Triller, stuff like that? Music plays on a Peloton class. There's probably a fee they have to pay to somebody. Reservoir Holdings is going to benefit from that as more and more people use it. And then royalty streams, right? They get royalty from restaurants, music releases, sync, live performances, etc. People cover a song, I'm assuming they get royalties. So COVID, the pandemic absolutely impacted that. But that's in recovery. So I think they'll be doing well in the future. So where do they fit into the industry? As a publisher, right? There's organizations that pay money to songwriters directly, or they pay money to the publisher that pays the money to the songwriters. So they work with digital services, whether it's Amazon Music, Spotify, Apple Music, YouTube, third parties. Talked about that in the last page. Foreign sub-publishers that they may own, record labels that may work with them as publishers or may work directly with the artists. And then they also have their own catalog of things they have and futures that they're working on. So money flows from all of these entities into the publisher's hands. They give it to the songwriters that they're working with, that they have co-ownership of things with. And then recorded music, consumers go to platforms where the money goes to the record label if they function as a record label, which they do for part of their revenue, and then that money goes to the artists. So music publishing, they have 130K plus copyrights with 11% organic revenue growth. No musical composition, so no one song accounts for more than 3% of the revenue. It's kind of crazy that one song is almost at least 3% of the revenue. And then 96% of the catalog has a retention rate of 10 plus years, with 76% for life of the copyright. So some of the deals you can make in this space, if you ever were exposed to it, is some of the deals are lifetime deals that you pay more money for the life of rights. Some of them are about 10 years, can be longer, can be shorter. So you are buying the rights to a catalog for a certain amount of time. It's obviously better if it's for the life of the copyright, because then the money is perpetual and you don't have to renegotiate or buy additional rights beyond that. But I'm assuming some of the better rights are shorter, which may mean there's some outlay in cash when it comes to their actual retention of those rights. But they have a pretty good retention date here. So legacy, you have active songwriters. Who do they have? Sheryl Crow, John Denver, the Isley Brothers, Leon Russell, the Commodores. What's the revenue mix? 54% is from digital, 24% is from live performances, 15% is from synchronization, so YouTube, whatever, Peloton, NFTs maybe, 7% other. And then gross profit, most of it comes from publishing. Some of it comes from the recorded side of things. And you've got a publishing gross margin of 56%, which is pretty good. Pretty good. So what are their top 10 songs by net publisher share, essentially how much money they make? It's interesting to see that this much of their revenue is driven by these few songs. Like they say it's only X amount, that 1857 songs out of the 130,000 that they own account for 80% of their net publisher share. But if you just look at, hey, It's Your Thing, Do What You Want to Do, Ring of Fire, Take Me Home, Country Roads, Middle Child, Disco Inferno, Yeah, Young Blood, In the Mood, Senorita, Bring Me to Life. I mean, you add those up, that's 3, 4, 5, 6, 7, 8, 9, 10, 11, 12% of their revenue comes from 10 songs. That's nuts, right? This is kind of where music publishing is very much driven by hits. If they can't get a catalog that's got hits that are going to last forever, or basically drive futures revenue through new hits, it might be a problem. But I mean, people are not going to stop listening to It's Your Thing. Great song. People are not going to stop listening to Ring of Fire. Great song. Take Me Home, Country Roads. Great song. I mean, these things are going to stick around forever. Hopefully they have lifetime rights for these suckers because they are great songs, and hopefully they get some new ones via acquisitions. And hey, they got Evanescence, Bring Me to Life. What a hit. What a hit. Was a huge hit back in my high school days. Everybody was rocking that thing. And then what do they got? Extensive catalog of evergreen copyrights and active songwriter rosters. They got Brick House. Brick House isn't generating that much revenue. When a Man Loves a Woman. Louie Louie. All About That Bass. All I Want to Do is Have Some Fun. Papa Don't Preach. Sexy Back. Oh, they're bringing Sexy Back. Is Sexy Back not in the top 10? How can that be? Just don't believe it. And then they've got a bunch of soundtracks as well over here. They've got the Dark Knight soundtrack. Cool. So music by ownership type publishing, where is their revenue coming from? Mostly North America, Europe. Lots of expansion potential outside of that. A release date, a lot of songs. You're making 9% of your revenue from the 1960s, 9% from the 1990s, 8% from the 1970s, a lot of it from the 2000s and 2010s and onwards. So there's still a big dependence on newish music, which is cool to see. But a lot of that is probably, hey, a lot of the people who actually are streaming music right now are potentially tend to be younger. So, certainly they listen to some old school music, but potentially more of it is newer. And then genre wise, a lot of pop, R&B, film and TV, hip hop. So a good spread. Could use a bit more rock. Got some Christian music in there if you're into that. Then you've got your recorded music, right? You're essentially not a publisher, but you're the label essentially at this point. So they got 26K sound recording copyrights, master copyrights. No master recording accounts for more than 8% of revenue. 70% of it comes from digital and streaming, as you would expect. And typically you've got 100% ownership of each master recording, and you've got a gross margin here that's slightly higher than publishing because you have more of the rights versus just being the publisher, where you potentially just have to pay more to other companies. And what are the top 10 titles by net label share? Middle Child by First Choice, J. Cole. I don't know what this is. Then you've got Nothing Compares to You by Sinead. Always something there to remind you. It's Your Thing by the Eiley Brothers. Cool stuff here. I mean, none of these stand out to me as like, wow, they've got this, they've got this, they've got this title. What a prestige title. So that's one thing to keep in mind. Are you investing in something that's got the best of the best? And I think the answer here is no. They don't have the best of the best when it comes to prestige titles. There's no Beatles here. There's no Rolling Stones. There's no Michael Jackson, stuff like that, Elton John, etc. Who owns that stuff? It's probably some of the bigger players. But they still have decent titles here. They have revenue generating titles, and that revenue is growing. So, hey, there you go. You don't need these things to be an amazing company. You can still depend on other stuff. So what's growing here? Streaming growth is really the play, and the gross margin there is expanding as the physical revenue declines. What are they doing as a value enhancer? I mean, we kind of talked about, there's other companies that you could go with. Why go with Reservoir Holdings? And hopefully we'll get that. We'll get an answer to that here. Really, at the end of the day, the music industry seems to be becoming more and more competitive. These valuations are getting higher and higher. So when people are competing for catalogs or rights to new artists or whatever it is they're competing for, there's more competitors now than there ever were. Hypnosis is out there buying a bunch of catalogs, raising the valuations of those catalogs. Universal might be out there, Warner might be out there, Reservoir might be out there. What's Reservoir doing that might make them a better target? One, I mean, they've had better revenue growth than the industry, so they're claiming that's based on the value add than everybody else. But what are they doing exactly? So they're sync. They're going to place the compositions into television, film, gaming platforms, toys, NFTs maybe. Who knows? No mention of NFTs though. Digital licensing. They've got to deal with YouTube, TikTok, Facebook, Peloton, Equinox, settlements. There's presentation on industry boards, advocating for creators to get them more and more money whenever there's infringement on their copyrights and stuff like that. Can they extract value from high quality catalogs with proactive pitching? Again, can they release new versions, remixes? Can they release NFTs? No mention of NFTs here. That's really what people are probably looking for from this company. If you want like a short-term price boost, hey, we're making NFTs. Hey, we're at $22. There we go. I think that's the thesis sometimes when people look at stuff like this that potentially has an NFT angle or something that's hot right now. Right now, there's no mention of that here, but I wouldn't be surprised if there's something down the line, but no mention in the presentation, which is a bit disappointing. Again, what are they doing? You can kind of look at some examples of their sync highlights. I'm not going to click on these because it's probably copyright infringement if I watch these, so no go there. What are they doing? Video monetization, derivative works, digital service providers, social media, fitness, working with all of these people, maximizing the amount of revenue they can get per listen, per use, etc. Giving that to the artists at a better rate than some of the other players, if that's what they do, but that's potentially a thing to do. Their representation and creator advocacy is there, generating settlement payments over the past 4 years for copyright infringement, etc., the usage without approval. So interesting stuff there. I don't know if I buy all of this. Like, are they any better than Hypnosis? Are they any better than Warner Media? Are they any better than Universal? I don't know. I mean, clearly they're growing faster, but again, they're growing faster because they're a much smaller base. I don't know if they're going to be able to purchase things at a better valuation because they have all these value enhancements. If that's true, then that's great. But I think if there's a competitive environment because so many people are trying to buy these catalogs, buy these rights, it might be tougher to be in this business than it used to be going forward. But we'll see. We'll see if that's true. So M&A platform, kind of what we're talking about. The company here has deployed $400 million. I don't know why I keep saying we. It's weird. It's like I'm on a sports team, and we're talking about a sports team. I don't even own this stock yet, but maybe I'm buying into it. $400 million capital deployed over 13 years. They've got 90% cost of gross profit cost synergies flow into EBITDA. They've got a 12% return since 2007, which is pretty good. And they're buying down the multiples from 12x to 10.7x. I'm assuming they mean by that the value that they're getting from the acquisition is better now than it was at the time. Okay. So you can kind of see that there have been a lot of acquisitions. Clearly the valuation, the multiples of these acquisitions have kind of gone up. They were buying things between 5 to 12x from 2010 to 2015. In 2018, Hypnosis came out. These valuations have kind of trended up. There's probably more players in the market, but what they're doing is they're taking those valuations and bringing down that multiple seemingly pretty quickly. They took this $50 million thing that was generating $3.5 million in revenue, and now it's generating $6.1 million within a year, right? So they're certainly showing that there's been value adds, at least more recently. Not so much over here where some of these shrunk down. And that's clearly what you want to see as an investor, that, hey, if you're buying something at a multiple, is that multiple coming down to a reasonable one? And clearly, historically, the reasonable multiple has been in that 10, 12x, and they're kind of in that average entry multiple of 13.5. And they're bringing some of those down to 10x or under pretty quickly within a year or two. So there's another purchase price acquisition for $61 million here. Decent IRRs, pretty solid return. If you can expect that in the future, if you're aiming for 10% plus returns from their transactions, that should come down to their valuation, and it should come down to stock growth. So again, you can kind of look at this company. Hey, is it valued fairly today? Yeah. Is there M&A leading to decent returns? Yeah. Then, hey, if it's valued fairly today and they're getting 10% plus returns off of their M&A activity, if they can continue doing that, then maybe you can expect 10% plus returns going forward from this investment. And it's not bad, even with no upside to what you're looking at, without, an upside driver like NFTs or something like that, or something that drives revenue growth beyond what we're seeing here. It's still seemingly a decent investment. and one that is vaguely interesting to me at this point, right? Because you're getting an asset that's unique, you're getting an asset that's growing, and they're certainly acquiring more of this. And if you believe that this little revenue growth isn't stopping, this industry-wide revenue growth pattern isn't stopping, that emerging markets are going to enter the fold in a big way by 2030 if the domestic markets pick up streaming even more. This is a good thing for companies like Reservoir Holdings. And the fact that they have a 30x valuation or 27x valuation, which is slightly better than the market, and the market values this industry around 30x, maybe that's the true valuation. Again, these are interesting assets that are different than the normal market assets you can get out there. There's a prestige to owning them, a luxury aspect to owning them, and potentially this is something that somebody else buys out down the line for that same reason. Hey, I want to own these great albums. I listened to Evanescence when I was 23 and I freaking love it and I want to own it. I'm going to pay a shitload for it because that's just what I want to do. So interesting business model. They're still continuing their M&A platform. They considered 204 new deals, made 77 offers, 42 deals went into exclusivity, 39 deals were closed. And then they've got 200 plus targets in the current pipeline with a 600 million plus total. So a lot of stuff going down the line. I mean, this is going to be this is the growth opportunity you have from this. I mean, Take Me Home Country Roads probably suddenly isn't going to get streamed 70% more than it was the year before. People still love that song, but it's, maybe it'll get used in a commercial here and there, something like that, in a movie where they can generate money off of that. But M&A is going to be a driver of their growth. And then futures are going to be a driver for their growth. Futures, again, we're signing artists to work with us for a period of X years. We're going to give them some money, and then we're going to own, or at least partially own, some of the songs that they write. You got 100 million plus in capital deployed. You got a 3-year contract, typically returning 23% of the average of the return that they invested in. 10.7 entry multiple on those investments if they're buying them from somebody else, I guess. Notable signings: you got 2 Chainz, Ben Harper, Migos, A Boogie with the Hoodie. Wow, great name. And then they have partnered with songwriters behind hits by today's artists, including Justin Bieber, Ed Sheeran, Ariana Grande, and Bruno Mars. So they're not really partnering with these people from what I get out of this. They're partnering with the people who wrote some of their songs. And then they got a Kelly Clarkson album in there. She's actually a pretty good singer. So what are they doing here? A couple of these investments that they've made a $7 million investment here, 14.5x NPS versus NLS multiple. So essentially returns can be pretty sizable here, anywhere from 4 to 61%. It's pretty solid figures as of December. It'll be interesting to see if any of these futures kind of become, they're not really specifying who it is. Obviously, anytime a new song is released and it's good, it can have an impact on current revenue really quickly. But is it going to stand the test of time like some of these other songs? That's really what you want to see. You want songs that are going to generate meaningful revenue beyond the first year where they're popular. And we'll see if any of these come out to be that, because you can't really see who it is that they're working with. Financials: attractive financial profile. You've got a growing organic revenue, strong cash flows, high margins. Agree with all that. What's the model overview? You've got revenue, essentially royalties minus the writer's royalties. You get your net publisher share. Margins there, I think we're in the 60% range. You've got your revenue, sales royalties minus the artist's royalties minus the manufacturing costs and distribution, which have a net label share. Margins there were in the 70%. You've got your operating income, licensing, talent expense, etc. Gets your EBITDA. Then you've got your revenue growth. 80 million in revenue. This is not a business I would probably value based on revenue, but again, 10x, kind of expensive for what you're getting. But I think these guys are just valued more than the market because of some of the reasons I mentioned. And some of the margins here are pretty good that are going to lend themselves to a higher valuation on a price over sales basis. But revenue growth here is pretty solid, projected to grow at 20% clip. This is not going to be a $1 billion revenue company anytime soon, if ever. Right? This is a small independent company. They're going to grow through acquisitions, through mergers and acquisitions, buying future catalogs. Hopefully they have some hits here and there through some of their futures investments, some hits that are more than just a 2-year span hit. And they're talking about, hey, some $100 million in reinvestments in the business outside of 2022, where a total of $200 million is deployed. So maybe they have a deal in the pipeline already. Because I think 2021 ended in March. So maybe this is the 2022 year already. Who knows? I don't know how their financials work, but clearly they have something down the line. And then forecast assumes a 75-25 split of M&A and futures, and assumes the cash to the balance sheet for transactions and debt repayments. So at the end of the day, this is still going to be a publishing revenue play. Some recorded music and other revenue plays are here. Maybe some of that acquisition is, I showed you probably from Chrysalis Networks that they bought, Chrysalis Records that they bought recently. So that's going to take it up. But still going to be, hey, we're growing revenue, publishing revenue for the most part. Why? Because there's expanding use of our music through streaming services, and that is good for the top line, but also the bottom line. Some of this revenue growth is organic. If you just look at organic revenue growth, right? And I kind of wish they showed this prior to 2019, because I kind of want to see if there was like an up and down spiral here. Clearly, if you look at this graph, the music industry kind of struggled between 2007 and 2014 or 15. So were they above here and they kind of went down again and went up? Is there going to be another struggle here that you have to be worried about? I don't think so, because of the way music is consumed these days, but really, who knows? Interesting thing to see. Pandemic, no huge impact to revenue, right? Hey, people are still listening to music when they're stuck at home or in their cars or wherever they go. People love music. And then they've got a track record of organic revenue growth. That's kind of cool to see. So they're not really dependent on M&A. Clearly the M&A is going to help, but a lot of this is just going to be internal organic growth, which is nice to see. Growth driven by strength of catalog, gross profit. You've got gross profit here, and then you've got your EBITDA, right? So we were talking about some valuations, 27x based on 2021 estimates, 20x based on 2022. Their EBITDA, high margin business here. If they can grow their revenue at this pace, they're certainly growing faster than some of these other competitors. If you look at Warner, Universal, they're probably in the 10% range. I don't know the numbers for Hypnosis. They're probably higher because they're kind of buying a lot of stuff out there. But you're getting pretty decent growth and pretty decent valuations if this is what you're going to see. Again, not a multi-billion-dollar business by any means. You're talking about millions, tens of millions of dollars in EBITDA, tens of $1 million in cash flow. So you have to temper your expectations here. But I think, based on what I see, none of this assumes any sort of digital expansion beyond streaming. Are NFTs included in this? Probably not. Is there upside from this number if NFTs become a thing? Yeah. But I think the reality is that this business is already kind of valued at a decent clip in relation to other businesses, right? If you're valuing the music publishing industry at 30x, there's got to be something behind it, and certainly this growth supports it. But the growth of the overall industry is nowhere close to 27% or 20% on the revenue side. It's closer to 7 to 10%, right? So if 7 to 10% growth merits a 30x valuation as some of these other players, does this merit a higher valuation? And if you're getting it at a 27x based on 21 revenue at $10, you're getting it at a pretty fair value. The risks that come with it is the market going to reprice these industries for whatever reason? Is it going to give it less of a luxury value asset valuation? If the multiples shrink, then could this go below $10? Yeah. But if they don't, then you've got a decent window of opportunity here to get a pretty decent return as long as the multiples stay the same. And if they expand, then you're sitting pretty. And if there's upside to this valuation from any sort of NFT things they can tie into their catalogs, then you're looking good at that point. The thing with NFTs is it's who actually owns the rights to an NFT. Do they have to get right approval from the artist? Do they have to work with the artist? Obviously, they're not just going to publish an NFT and not give any money to the artist, I would hope, or otherwise the artist would be pissed. But it'll be an interesting thing to see and develop. However, based on this valuation, I also don't think you're desperate for NFTs to be a thing, for this to return, 10% a year or something like that. Even if this business kind of chugs along, it'll probably give you 10% a year after all is said and done. There's going to be some dilution with warrants, so you have to keep that in mind. After it goes actually public, there may be a period of time where this boring business isn't really recognized by anybody. It's not properly valued. Might have to wait until earnings are announced to say, hey, this thing is actually growing at 30%, 27%, whatever. And if that's the case, then the multiple may shoot up a little bit. Then you might have a little bit of a reprice to get it there. And as long as they keep chugging along, if you're getting 10 to 12% out of something like this, it's not unreasonable based on the financials and based on the valuation you're getting in relation to the valuation of the other players in the space, right? So it's already producing free cash flow, not dependent on this cash to the balance sheet that they're getting, but they're certainly going to have that money to deploy it. The problem is they also have a bunch of debt on the books already, so some of that is probably going to have to come, some of that cash is probably going to go to debt repayment. Some of that cash is going to acquisitions. Like they mentioned, they have quite a bit of acquisition potential in the pipeline. But at the end of the day, you're already producing 20 plus million by next year, almost 20 million rather, by next year in free cash flow. You can take on additional debt as needed to fund growth. Hopefully some of these future guys pay out. And you're paying a decent multiple for that, right? You're not losing a ton to the sponsors. You're obviously going to. There's about 5.9 million in warrants outstanding, which isn't a huge amount of dilution. 74 million in shares means it's relatively low float, which means that if there is an announcement about NFTs, this thing can potentially fly. You kind of see that in companies like PLBY, where it's like, well, we're doing slightly better than we thought we were going to be doing, and we're potentially entering the NFT space, and this thing is $40. Now, I'm not saying that ROCC is going to $40 because it probably isn't, but there's potential for something like this, which is fairly valued on the basis of its financials, to have a little bit of a run if there is an announcement around something that's trending. That's all I'm saying. And I think NFTs are certainly a space they could get into, and they should get into. It'll be good for them, and it'll be good for the artists that are signed with them or working with them. But it doesn't require them to do so for this to be a decent investment, is my take. Plus, you're owning a part of Evanescence's album Fallen. Who wouldn't want that? I certainly do. So we're talking about financials, revenue growth here. We kind of talked about, hey, the other guys are probably in the 10% range. We're in the 20. Reservoir. I keep saying we. What am I doing? Reservoir Media. I do not work for Reservoir Media, and I am also not a qualified financial advisor to tell you anything. So please do your due diligence before you make any investments. So got that in there. I don't know why I keep saying we. I must be on like a team train or something like that. So good growth rate for these guys. Gross margin is better than the industry for these guys. EBITDA margin better than the industry for these guys. EBITDA over gross margin based on their 2022 estimates better than these guys. They've got an EV over EBITDA multiple. They say it's based on 2021 estimates, but I think 20x is based on 2022 based on those other values. But either way, you're talking about slightly better than the other guys, 27 versus 30 based on 2020 estimates, which kind of falls in line with this, 20 versus maybe 23 based on 2022 estimates, or 21, whatever it was. Valuation is fair. It's not great though, right? I mean, that's comparable, so at the end of the day, you're asking yourself, is this investment better than Hypnosis because the valuation's in line there? Is it better than Universal? You can't buy Universal, but you can buy Tencent Music, which owns a part of Universal. Is it better than Warner Music Group, which you can buy on the stock market today? I think the answer is, yeah, maybe. It's a smaller starting point, so there's more opportunity for growth. Revenue growth historically and based on their assumptions here is potentially going to be better. If that turns out to be true, this should perform better than those other stocks because you're already getting a slightly better multiple at today's price. It's probably closer to even once dilution is taken into account. But you have the potential to grow faster, right? And if you're expecting, 7 to 8% return from those other guys, maybe you'll get 10 to 12 from these guys if they can execute on their strategy here. And if there's potential for more out of this, If suddenly NFTs on the music space become a big deal, I mean, there's already some out there, and Reservoir can get in there and do some deals, make it happen, then they're in a good spot. And also, I think they're doing a good job of expanding just beyond America. I watched an interview with one of the, I think the CFO, and he kind of said, hey, we're expanding into the Middle East with the investment in Pop Arabia. They're signing an Indian rapper, working with some companies in China, expanding into film scores. They have an entry into podcasts coming up with a podcast developer. There was also a mention of a potential acquisition coming that's alongside the merger. I think people are hoping, hey, is this some sort of tech platform they can use to move into the NFT space? Or, it's probably just going to be another catalog acquisition, potentially an acquisition on the podcast side, which was mentioned in that interview. Is there going to be something they can do in podcasts? Is that another revenue stream for them? Is it going to be big, small? Who knows? But they're certainly moving into it, just like Spotify moved into it. They see it as something that's emerging as a revenue driver, and it's good to see that Reservoir isn't kind of letting that slide by. And I think if they're moving into that direction, are they going to move into NFTs? My hope would be yes. If I'm an investor here, I think I would say yes. If I'm thinking about investing here, I think the short-term thesis is, hey, if they announce something on the NFT side, this thing will get a boost and I can get out, especially on the warrant side. If you're playing with warrants, be careful with those though, because they can certainly cause you to take a big loss, as we saw in the last couple of months if you were a warrant buyer before the big SPAC crash. But hey, this has upside potential in the short term, but I potentially see it as a decent investment in the long term. So they're kind of saying, hey, there were some public or private market transactions. Hypnosis bought Cobalt for $323 million, which is about a 27x EBITDA. Again, they're using 2022 EBITDA as a multiple here, kind of in line. So like I'm saying, I think the valuation here is fair, right? Which is a lot more than you can say for some of these other businesses that we've seen go public in recent memory. I think that's trend is ending. The valuations are becoming more realistic, and the valuation here is in line with valuations you see of other similar assets that are out there in the public or private space, or changing hands in the private space, right? It's 27x on 2021, 20x on 2022. It's fair, right? So if it's fair and the industry is supposed to grow at 7 to 8%, and you believe that that's true, and you believe that the valuation won't shrink because this is a luxury asset or whatever, then you're going to get a bit more than 7 to 8% out of this investment. And I think that's a fair assessment. I don't mind the music publishing business. I think it's a cool thing. It's a cool asset to be a part of. Like, hey, I own this Ray Charles album. Very cool. Very cool. I own, 0.000001% of this Ray Charles album because of my 100 shares that I may own. It's kind of cool, kind of neat. And the valuation's cool. Valuation is good, rather. And you've got these other things that are potentially down the line, right? So they're working with Outdustry in China. They're working with ESMAA in the United Arab Emirates. They're working with Pop Arabia, kind of spreading into the Middle East, working with those emerging market artists, but also benefiting from the expansion of streaming into the emerging markets. There's the film division. They're working with film scores. They have a repertoire of film scores owned by Hans Zimmer, who's chef's kiss. Really good stuff that guy does. Management side of things is working well. They're a new deal with a podcast company. We'll see Reservoir invest in podcast listenership. Is that the deal they talked about in the release of this investment? I don't know. But at the end of the day, you're buying into a company, into a management team that you hope is going to drive good results in the future, that has a proven M&A platform, and you want that to continue to grow. And potentially there's some upside in NFTs. Is there? Who the hell knows? Let's be real here as investors. Who the hell knows if NFTs are just a boom and bust type of thing? Are they here to stay? Can I release Evanescence's album Fallen on NFT as a 10-year anniversary edition and sell 10,000 limited copies for $49.99? Maybe. And if if I'm Reservoir Records, maybe that's what I do, and I get into the NFT space because, hey, it's kind of on the up and up here. And if it sticks around, even if it becomes a small little collector haven thing that speculators are no longer driving the price of these things to unreasonable levels. Hey, if I am a Kelly Clarkson fan and they release 1,000 copies, one-time release of Kelly Clarkson Stronger on the NFT, do I want to own that? Yeah, why not? If I can pay $10 for that, I'd probably, for whatever reason, it's probably easier for somebody to pay $10 for that than buy an actual album. And the margins are better. People buy random BS on the internet all the time, video game widgets and video game skins and stuff like that. Why not buy an album on the blockchain for $10 and give some money to Kelly Clarkson and Reservoir Holdings? So I think there's upside here. I think the return, if the management can continue doing what they've been doing, is going to be reasonable. The valuation isn't amazing, but it's fair. And their growth potential is better than some of these other players in this space that are valued at a similar level. The other players are bigger, and they potentially have more of a stronger hand when it comes to making deals and kind of pushing Reservoir Media out of certain deals, which is a potential problem. Can they compete against these big players in a market that's getting more and more competitive? Those deals that used to be 5 to 10x are now 17 to, if anything, 27x, right? The private transactions are becoming a lot higher. 24x in 17, 24x in 21, 27x in 20. So can they continue making acquisitions below 20x, or is somebody else going to scoop it up at a higher price? Is M&A going to become harder? Is their EBITDA margin going to be lower because they have to spend more money in acquisitions, take on more debt to do so? There's certainly risk with a small company like this. I'm not saying this is a slam dunk, but I think at least it would be maybe a small market beater because of the industry is in and the multiple it can get for being in this industry and the growth it can potentially get due to their small size. And the NFTs are a little cherry on top of this investment. So I don't think this is as bad as an investment as I've seen some people make it out to be. This is one of those whatever type investments when you look at it. But when you get into the details, when you look at the industry it's in, it's a fair deal for investors. It's a fair deal for the company, I think. The ROCC didn't overpay, but the company got a decent valuation that's in line with everybody else. They get a pretty big cash infusion that they can use to pay down debt, improve their balance sheet, have some acquisition fodder out there, and sort of start growing that revenue and become more of a free cash flow company than they already are. And, it's not a slam dunk by any means. This isn't like, wow, this deal is so great. If I had to choose between this and Topps that I reviewed the other day, I'd probably go with Topps because it's an easier NFT sell, and actually they already have NFTs going on and there's more upside there, and the valuation is maybe a bit more fair in relation to this because this is clearly valued at a higher multiple than the market for some reason. And I think part of that reason is that it's more of a luxury asset and it's more of an expanding industry than it used to be. There's growth potential here that exists as these streaming services move into emerging markets, as companies like this do more and more stuff on the technology side that I think they can take advantage of and make more money. So decent deal, decent balance sheet. I will probably buy a bit of this just because I have a couple of months to wait it out. I can get it under $10. I don't know what the warrants are trading at. Maybe I'll buy warrants here. Warrants allow me to buy this company at $11.50 if I want. They're trading at $1.31. It's not super amazing, but not bad. More upside with warrants, more risk of it going to zero. If it doesn't pan out, it's kind of like an option. If you're not familiar with warrants, I would probably not play with them. But there's more upside there. If within the next 4 months, these guys announce something on the NFT side, I could see this getting a boost. If they don't, I could still see this being a decent investment, 5 to 10 years down the line. Is it going to be a $100 stock in 3 months like some of these others? Is it going to be a $100 stock in 5 years? Probably not. But is it going to potentially give you 8 to 10 to 12% year over year Is it going to be relatively immune to, at least from an earnings perspective, multiples can still shrink to either, pandemics or economic crises or whatever? Yeah, people are going to listen to music. These guys are probably going to do well. They are an uncorrelated asset, like they mentioned. And even if their stock price drops during a recession, their earnings are still probably going to be okay. And you can probably just buy it at a decent deal at that point. This is one of those things that are going to be like, they're falling with the market, but they're not really falling because of any specific reason. It's just that the market does what it does. So interesting investment here. I am interested in the music publishing space, and I kind of like what this deal looks like. So I may just take a little nibble, just to own a piece of the pie, own a piece of Evanescence's album Fallen. And whenever I'm in my car, I'm going to turn on Evanescence Fallen on repeat so that, all of that money, all of that Spotify, Apple Music money is going not only to Amy, whatever her last name is, of Evanescence. I'm surprised I know her first name, but also going to these Reservoir Holdings shares that I may own at that point. So guys, let me know what you think about ROCC. I think it's kind of a missed opportunity here that is somewhat interesting. Like I said, I don't love it. I don't think this is a go out and buy this today type of deal, but I think it's got the potential to be a good compounder across the years if management sticks with what they've been doing, if they hold to their guns and make deals that aren't at a very high multiple but are accretive to cash flow, and continue to keep investing in new and interesting growth opportunities. And if there's some NFT play down the line, then hey, that's a cherry on top. It certainly would help, and I certainly don't see why they wouldn't at least attempt it. But it's not. This is not an investment that's dependent on that. I don't think Reservoir Holdings and Rocc made this deal because Rocc knew that they're going to be releasing NFTs tomorrow, and this is going to spike because NFTs are the new rage. You want to buy businesses that have a reasonable valuation. This valuation, if you look at it just from the marketplace standard, it's probably steep. But if you look at it in comparison to other players in the industry, it's fair. It's decent. It's good to fair, right? Based on their growth. So as long as we don't see a shrinkage in that multiple due to whatever reason, and I don't think we will, because this is, like I said, a luxury type investment asset, whatever, uncorrelated, unique, some diversification, because if this is truly an uncorrelated asset, then it should kind of perform differently than other assets. I don't know if that's true. I think this will still fall if the stock market falls, but at the end of the day, it's another little thing that you may consider as an investor, and you're getting Kelly Clarkson, so getting the Kelly Clarkson album, part ownership in the Kelly Clarkson album. So come on, clearly a reason enough to invest there. Again, I'm not a qualified financial advisor. I don't know if that last comment made you think otherwise, but I am not. Please do your own due diligence. Do not invest simply because it has a Kelly Clarkson album or an Evanescence album or Take Me Home Country Road on there. Clearly that's a cool thing, but this is real money we're talking about here, so keep that in mind. Guys, thank you for watching. Hopefully this was a cool video for you to watch. I'll do more of these. If you want me to review any specific SPACs, let me know. Again, I'm just doing these for fun. I am not a qualified financial advisor, but thank you for watching. Hope you have a good weekend. If you're watching this on Friday, I'll probably upload it today, and I made it today, so if not, watch it whenever. Enjoy. Leave a like, leave a subscribe, leave a comment. It's all helpful. I'll do more of these. I enjoy them. It gives me a break from work. Thank you. Have a good rest of your day.